Many people dream of financial freedom, but fear often holds them back from taking the first step investing. The stock market might seem like a risky and complicated game reserved for experts. However, the truth is far simpler. Investing in stocks, when done wisely, is one of the most powerful ways to build wealth over time. It's like planting a tree. The sooner you start, the more it can grow. This guide will demystify stock market investing for beginners. You'll learn the basics, explore historical returns, and discover how everyday people have achieved financial success. More importantly, you'll receive a clear roadmap to begin your own investing journey. It's time to unlock your financial future and take control of your money. What exactly are stocks? Stocks, also known as shares or equities, represent ownership in a company. When you purchase a stock, you are essentially buying a small piece of that company. This ownership entitles you to a portion of the company's assets and earnings. Imagine a company like your favorite coffee shop. This coffee shop has been doing well and wants to expand. To raise money for this expansion, the owners decide to sell shares of the company to the public. When you buy stock in that company, you're buying a small piece of ownership. This means you now have a stake in the coffee shop's future success and growth. As a part owner, you participate in the company's success. If the coffee shop does well, the value of your stock may increase, and you could potentially make a profit. If the coffee shop thrives and its value increases, so does the value of your stock. This is one of the primary ways investors make money in the stock market. There are two main ways to invest in stocks: individual stocks and ETFs, or exchange-traded funds. Each has its own set of advantages and risks. Buying an individual stock means owning a piece of a single company like Apple or Amazon. This can be rewarding if the company performs well, but it also comes with higher risk if the company faces challenges. An ETF, on the other hand, is like a basket of stocks. It allows you to invest in a diversified portfolio of companies, which can help spread out risk. It allows you to invest in a collection of companies such as the top 500 companies in the US market, represented by the S&P 500 index. This diversification can provide more stability to your investment. Stocks increase in value in two primary ways. The first way is through capital appreciation, which occurs when the price of the stock goes up. First, as a company grows and becomes more profitable, its stock price tends to rise. This increase in stock price can result in significant gains for investors. Second, some companies pay dividends to their shareholders, sharing a portion of their profits. Dividends provide a steady income stream and can be a great way to earn money from your investments, even if the stock price doesn't rise significantly. One of the most compelling reasons to invest in stocks is the potential for long-term growth. Historically, the stock market has delivered significantly higher returns than savings accounts or bonds. For instance, the S&P 500 index, which tracks the performance of 500 of the largest US companies, has historically returned an average of around 10% per year over long periods. Imagine putting $1,000 in a savings account earning 1% interest versus investing it in the stock market. After 30 years, the difference in returns would be substantial. It's important to note that past performance is not indicative of future results. The stock market can be volatile in the short term. However, over the long term, it has consistently trended upwards. You don't need to be a Wall Street tycoon to build wealth through stocks. In fact, many successful investors started with very little and built their fortunes over time through smart, consistent investing. Countless ordinary people have achieved financial security and even become millionaires by investing consistently over time. These individuals come from all walks of life, proving that anyone can achieve financial success with the right approach. Take, for example, the story of Grace, a school teacher who started investing small amounts of money every month in her 20s. Despite her modest salary, she understood the power of compound interest and the importance of starting early. She diligently added to her investments, taking advantage of compound growth. Grace didn't let market fluctuations deter her. She stayed the course and continued to invest regularly, knowing that time in the market was more important than timing the market. By the time she retired, Grace had amassed a seven-figure portfolio, securing her financial future. Her story is a testament to the power of patience and perseverance in the world of investing. There's also John, a factory worker who invested in the companies he understood, the ones making the products he used every day. John didn't have a formal education in finance, but he had common sense and a keen eye for quality. He researched those companies carefully and invested for the long haul. John knew that investing in what he knew and believed in would pay off in the long run, and he was right. Through his dedication and patience, John also achieved financial independence. His journey shows that you don't need to be an expert to make wise investment choices. You just need to be informed and committed. These stories highlight a powerful truth. Consistent investing, even with modest amounts, can lead to extraordinary results over time. The key is to start early, stay disciplined, and keep learning along the way. You don't need to be an expert or have a lot of money to get started. With the right mindset and a commitment to your financial goals, you too can build a secure and prosperous future. Section 5. Your Roadmap to Investing, a step-by-step guide. Now that you understand the basics, let's outline a clear path to begin your investing journey. Step 1. Define your financial goals. What do you want to achieve through investing? Are you saving for retirement, a down payment on a house, or your child's education? Having clear goals will help you determine how much to invest and for how long. Step 2. Open a brokerage account. A brokerage account is your gateway to the stock market. It's where you'll buy and sell stocks and ETFs. Numerous online brokerages offer commission-free trading, making it easier and more affordable than ever to invest. Step 3. Fund your account. Transfer money from your checking account to your new brokerage account to begin investing. Section 6. Navigating the market. Choosing your investments. With your brokerage account funded, it's time to choose your investments. This is a crucial step in your financial journey, and making informed decisions can significantly impact your financial future. Here are some key considerations: individual stocks versus ETFs. Individual stocks represent ownership in a single company, while ETFs, or exchange-traded funds, are collections of stocks or other securities. As a beginner, starting with ETFs is often recommended. They provide a way to invest in a broad market index or sector without having to pick individual stocks, which can be risky and time-consuming. They offer instant diversification by spreading your investment across multiple companies, reducing your risk. Diversification is a key principle in investing, as it helps to mitigate the impact of any single investment's poor performance. Risk tolerance. Consider your comfort level with risk. Everyone has a different risk tolerance, which is influenced by factors such as age, financial situation, and investment goals. Are you willing to tolerate short-term fluctuations in your portfolio value for potentially higher long-term returns? Understanding your risk tolerance can help you choose investments that align with your financial goals and comfort level. Investment horizon. How long do you plan to invest your money? Your investment horizon, or the length of time you expect to hold your investments, plays a crucial role in determining your investment strategy. If you have a long time horizon, several years or more, you can afford to take on more risk. This is because you have more time to recover from any potential losses. Research and due diligence. Before investing in any stock or ETF, take the time to understand what you're investing in. This involves researching the company, its financial health, and its future prospects. Research the company, its financials, and its future prospects. This due diligence can help you make informed decisions and avoid potential pitfalls. Remember, investing is a journey, and making informed choices is key to achieving your financial goals. Section 7. Avoiding pitfalls. Common beginner mistakes. Even experienced investors make mistakes, but beginners are especially susceptible to common pitfalls. Here are a few to avoid. Emotional investing. Making impulsive decisions based on fear or greed. Stick to your investment plan and avoid letting your emotions dictate your actions. Chasing returns. Trying to time the market by buying high and selling low. Instead, focus on long-term growth and avoid short-term speculation. Lack of diversification. Putting all your eggs in one basket by investing in only a few stocks or sectors. Diversify your portfolio across different companies, industries, and asset classes. Overtrading. Buying and selling frequently, which can erode your returns due to trading fees and taxes. Section 8. The long game: patience and consistency in investing. Investing is a marathon, not a sprint. It's crucial to adopt a long-term perspective and resist the urge to chase quick profits. The stock market will inevitably experience ups and downs, but over time it has consistently trended upwards. One of the most important keys to success is consistency. Even small contributions made regularly can lead to significant wealth accumulation over time, thanks to the power of compound growth. Section 9. The importance of diversification. Don't put all your eggs in one basket. Diversifying your investments is crucial for managing risk. This means spreading your money across different asset classes, stocks, bonds, real estate, sectors like technology, healthcare, energy, and even geographies such as the US and international markets. Diversification helps to cushion your portfolio from losses. If one investment performs poorly, others can help to offset those losses. A well-diversified portfolio is essential for long-term investment success. Section 10. Embracing the journey. A lifetime of financial growth. Investing in the stock market is more than just a way to make money. It's about taking control of your financial future. It's about building a solid foundation for yourself and your family. It's about achieving your dreams and living a life of financial freedom. The journey may seem daunting at first, but remember that every expert was once a beginner. By following the steps outlined in this guide, avoiding common mistakes and embracing the principles of long-term investing, you can unlock your financial potential and embark on a lifetime of financial growth. Remember, the best time to plant a tree was 20 years ago. The second best time is today.